Let's now have a look at the Vanguard bond equity spreadsheet to get an idea of our asset allocation between bonds and equities. And in this case, I've downloaded the Vanguard Fund VBMFX, kind of hard to say that, which follows the Bloomberg Aggregate Bond Index. And I've also downloaded VFinX, which follows the S&P 500. And we're going to reinvest the dividends on both of these to get an idea of just where we're at in terms of our overall investment portfolio with this asset allocation between a bond fund and an equity fund. By the way, the bond fund starts in December of 86. So I'm going to actually start the investing in both accounts at the beginning of 1987 over here. We can adjust that if you want. You can adjust it by changing the date here. Here's where you put in how much money you want to invest in bonds and how much money you want to invest in equities. Now, let's just say we have $10,000 for bonds and say $40,000 for equities. So that would be a 20% in bonds and 40% in equities. And the total then investment would be $50,000 starting at the beginning of 1987. Down here on the plots tab, you'll see the plot. But if you download this spreadsheet, it's possible that you may need to adjust the axes. See, it starts in January 2017. We need to add a few more years to that. So right click on the tab for bond, unprotect for plot, I'm sorry, and then unprotect the sheet. And now you can double click on the bottom x-axis, double click on that. It'll bring up a scale over here where you can set this up, let's say January 1, 1987, hit the return. And let's go over here and say January 1, 2025, hit the return. And now you see the full array of data through there. Now let's make the y-axis bigger, double click that, and just reset that by clicking on these two round shape arrows. And now you can see the overall plot in front of us. So what's interesting about this is with $10,000 invested in the bond fund, it's going to follow this red line, and we just can't really see much of what's happening along that red line. The blue line is the equity fund, VFinX, and the green line is the summation of both of them. It's in particular, I want us to look at the lost decade. During the lost decade is when our bond funds are really important to us. In particular, I want you to understand what I mean by a bond floor. So, in order to see what's happening in the bonds and make a better visual comparison to the equities, let's go back to the prices, reset these so that they're equal to one another. Let's say 25,000 in each of them for a 50-50 distribution between our assets, our two assets. And now we begin to see, okay, we started at 25,000 in both of these, and then the blue line takes off and really grows up to say 200,000 or so, which would be a very exciting time in the first 10 or 15 years of investing. The red line is only going to about 66,000. So far, if we stopped our visual right here, we'd be very excited to be in the blue line. In fact, we might even ask ourselves, why didn't we pour more money into equities instead of bonds? Well, this is why we're looking at the lost decade. As we go across through here, this right here, 2007 to 2009, that was the Great Recession that occurred around 15, 20 years ago. And that Great Recession saw a massive loss in equities. Look how the blue line now touches the red line. It's as if they started all over again at the same values right here. Obviously, there's been a great bull market since then, but we don't want to look at where we end up and then say, well, I should have put all my money in equities because we don't know that this is what was going to happen. What we do know is this did happen, and we want to be careful about how we distribute our monies between equities and bonds. This red line becomes our bond floor. And right in through here, during this time, this money in the red line, you see it hardly even changes in through here. If all I did was show you the red line, you would be like, what happened to the Great Recession? It doesn't really even occur along that red line. And that's the importance of bonds in this particular example. We see that they helped us through the recession. Your bond floor here at about $100,000 or so would have been very advantageous to have to provide you with the security you needed during the Great Recession. Now, most people don't go with a 50-50 split, certainly in their early investing life. Generally speaking, they're around 20% or even 10% in bonds. But let's now just switch this around. Let's go all the way up to say 80% in bonds. So we'll put $40,000 there and 10,000 in equities. And now we'll really begin to be able to see this red line. Look how the red line has hardly any variation in it at all for about 30 or so years, despite the lost decade and the Great Recession that occurred in equities. And so this bond floor becomes very helpful to us when equities are performing poorly. Over here, this is a result of inflation going up, and therefore the Fed said, okay, we better increase the interest rates, the Fed lending rate, and therefore when interest rates go up, bond prices go down, and therefore the red line goes down in through here. So this isn't a perfect situation. There are times when bonds can, in fact, lose money. But we have to be careful about equities, especially because we do see there's volatility in those equities more so than in bonds. Let's go back now to the prices. And so, what I'm going to ask you to do is think about your overall bond floor and how that impacts your decision making. Let's set this back up to $10,000 and $40,000, which would be a 20-80 split. And that we can go back to the plot and see that during the Great Recession, this person would have had around $45,000 that they could have counted on. Let's say they lost their job, but they still need, and they lost a lot of income in their equities in through here. During this time right here, as the equities were going down, they didn't know this was going to happen. We didn't know that was going to occur. But during this time when equities were going down, they would have looked at their bonds and said, well, there's no change occurring there. We just saw that when the red line was more visible. And they would have had around $40,000 to $45,000 in their bonds. That could have been a very secure foundation for somebody who is perhaps single and maybe lost their job, yet they would have had that money available to them should they needed to pay their rent and to continue to live on, paying their utilities and so on, and get through the Great Recession and hopefully find a job where they could start investing back into their equities again. So that's what a bond floor does. It helps us get through bad times, and we don't want our overall investment portfolio to fall below that bond floor. So in other words, we don't want to have this red line so small that it doesn't actually provide us with enough money to live off from. And so set this number so that your bond floor becomes that minimum amount of money that you must have in order to live on. And then you can invest the remainder into the equities. That's how I regard my bond floor. So I hope that's helpful for you. I'll stop it here.